Hey everyone, welcome back to the channel. And in today's special video, my mortgage broker is going to show you how you can save tens of thousands of dollars on your mortgage renewal. So stay tuned. Hey everyone, welcome back to the channel. Mark Newstater with eXp Realty, and I'm joined in this video by Jayden of Avenue Financial. Jayden is our personal mortgage broker. He helps out all of our clients that need mortgage help. And so we wanted to do this video today because it is important, right? Your home is typically the biggest asset you will own for most people. And so what we want to share with you today is an actual way that you can save tens of thousands of dollars, in some cases 50,000, in some cases more than that, depending on what your mortgage amount is. And so Jayden's going to walk us through this, and we will post links to Jayden's information in the show notes. So please reach out.
Yeah, and so I guess the genesis from my side is that I've been having a lot of these conversations this year, and people are absolutely panicking. And my message to you is don't panic. It's going to be painful, but let's try and keep that pain to be as little as possible. And I think there's a way forward for that. And so, I do a lot of thinking about where rates are going, where they've come from, and what has happened in the past. And it is kind of govern what I think about what's going to happen in the future here. So if I look back at this year, 2022 was when we really started to see things take off. I think April of 2022 was our first rate hike. It was either April or March. And it's just been a consistent hiking cycle ever since then. It just the Bank of Canada has jumped by 1% at times in a single bound. It's been really incredible, right? So we continue to see that through 2023. And what happens with that when central banks are making those kinds of decisions? It's usually because there's something happening in the background, and that really affects the bond market, which is more free flowing and affected by the decision making of investors and things like that. But when there's instability in the bond market, generally speaking, that pushes bond yields up, which also pushes fixed interest rates up. So not only have we seen variable interest rates shoot up over the last 2 years, we've seen fixed rates follow in a consistent manner with them, right? So right now, what I see coming up, we've seen a couple of rate pauses, both in Canada and the United States, because there's a lot of things happening in the background that are saying to us, okay, guys, get prepared for a recession. The Bank of Canada keeps talking about a soft landing. They historically have been horrible at predicting exactly how their policy was going to affect the economy. So, in my personal opinion, and a lot of the numbers that I'm putting up there are based on the way that I think things are going to play out. In my personal opinion, we're heading into a pretty significant recession. And you'll see in the next slide that recession affects rates significantly. So, last 50 years, we've had 5 recessions. In 4 out of the 5 of them are going to be similar. We had one little recession during COVID that was a technical recession, but it was more everybody was forced to be in their homes. There was that, the economy was just shutting down. And so that was kind of the point before the government started putting money in the economy. But in the lead up to 4 to the 5 of them, we saw a lot of similar things. We saw interest rates start to rise, saw inflation, and we saw really, really strong employment, which is interesting because everybody says, well, how can we be heading into a recession? Employment is so strong. Well, in the last 4 of the 5 recessions, employment was really strong leading up to that, right? So 4 to 5 of them, like I said, preceded by incredibly fast rate hikes. Nothing like we've seen this time, but they were. And then the response to all 5 of these recessions has been the same. We have seen interest rates come down as much or more than what they went up, right? It's just really have been driven down significantly. In this particular recession, which I think is coming, we're already technically in a recession, but I think it's going to be a lot harder hitting than it has been so far. In this particular one, I don't believe that we're going to come down as far as we were. COVID was just an outlier, right? And so we went down to about as far as the Bank of Canada was willing to go with their overnight rate at 0.25%. So a lot of the thinking that I have going forward is what we're going to do, in my opinion, and what we're going to see over the next couple of years. we're gonna go back to what I would consider normal rates between 2.5% and 3.5%. Post 2008, which was the last kind of major recession that we hit, we've had a glut of borrowing happening, and it depends on these rates being between 2.5% and 3.5%. So that's where I think we're headed. And so now let's get right into the meat and potatoes of this. I know I'm talking and talking, but this is the effect of that, right? So when I did this slide, fixed interest rates have come down slightly, but at the time they were around 5.84% on an insured mortgage. And if you've followed any of Mark and my stuff, you know that that means you put less than 20% down on your mortgage. And the 2-year fix on an insured mortgage was around 6.39%. If we assume that you have a $500,000 mortgage, that you have 25 years left on your mortgage, that's a monthly difference of $164 a month. You know, over 60 months, you're looking at about a $10,000 difference there. That is significant. It's tough to make that decision to be paying, potentially if rates continue to go the way that they go, an extra $10,000 over 5 years. The reality of it is, if rates go back to where we think they are, I'm assuming 2 years from now, you'll be able to get a 3-year fixed rate at around 3%. If you go back down to 3%, you're not actually paying that $10,000 over 2 years. Actually, the impact is far different from that. You know, if you look at your total payments, if you kept that 5.84, $500,000 over the next 5 years, you're looking at about 190,000, just short of that. About 137-ish is due to interest. So really, you're only putting 60,000. You're going to walk away with about 440 against the principal of your mortgage. The total, if we combine this 2-year at 639 and this 3-year at 3, is 165-ish, 166-ish, which is, you know, $24,000 less than what you would be paying on over that 5 years. But the really interesting thing is that you're paying around $34,000 less in interest over that 5-year fixed period. The net effect of that is that not only have you paid significantly less in payments, you have also paid significantly more on your principal. And so now that 440 looks more like 420. So, you know what I mean? Like you're coming out of that paying less and being further ahead. It's fantastic. And so I'm a big variable believer. It's been tough for people who've been riding this wave as things have gone up, but it could be even more impactful if you decided to take a variable right now, right? So we're looking at that same 5-year at 584. Current variable is about prime minus 0.9. Prime is 7.2%. So you're looking at a 6.3%. Again, the monthly difference, you're looking at around a $10,000 difference over that 5 years. But what did we talk about with recessions, right? So if you believe, as I do, that we're on the verge of a recession, and that it's going to hit maybe a little bit quicker than you think it is in the spring of 2024, you could have significant, incredible savings by going with variable right now, right? So if we assume that prime next year falls by 1.75%, that's a third of what it went up with that 4.75% hike. And then it falls again by 2% in 2025. And when I was doing these calculations, I didn't say January 1st, 2024, it falls it's spread out over the year, and done at different times as the bank does. They meet 8 times a year. You're looking at savings of $40,000 of payments over the year. You're looking at savings of $56,000 worth of interest payments over the year. And now that's incredible. Like the ability to pay down your mortgage faster by going with variable right now is unbelievable. The other side of that coin is some people are going to say, well, Jayden, what if interest rates go up? Then what's going to happen to me? I'm going to say, in my opinion, I'm not. I've got boots to the ground. I've done a lot of research on this. I don't have a crystal ball, and I can't tell you that this is absolutely what's going to happen. In my opinion, we're on the edge of a recession, and a recession is going to cause things to happen this way. As you can see, I didn't go down the full 4.75%. It was 3.75. So I've left a 1% cushion there. I think this is where we're heading. If you do a little bit of research behind the scenes and look at the way the media is talking about things now, I think a lot of the media thinks this is where things are heading as well. So I just think it's so worthwhile to have that conversation right now. You don't have to move your mortgage over to me or to another mortgage broker. We might tell you that there's a better deal at the bank, but you really need to think now more than ever. You definitely should not be just signing that 5-year fix and sending it back to your bank without talking to anybody.
Absolutely. Jayden, thanks so much for joining us today.
Of course.
So that was invaluable information from Jayden Bax of Avenue Financial. As always, if you liked it, give it a thumbs up. More importantly, though, for this video in particular, share this with somebody you know who is coming up with a renewal in 2024, who's looking to purchase. There are ways to not have to go with that 5-year fix. Jayden Bax is your man at Avenue Financial. And if you could, subscribe to the channel. We'd love that. We really appreciate the support, and we'll see you next time.